Today we're going to go over our best trading setups from the week for our 50 pips a day trading system. We're going to review our simple trading method, and we're going to go over the 3 things that markets do. You don't want to miss this, traders. We'll be right back. G'day traders, I'm Stacey Burke from Stacey Burke Trading. I thought it was a fantastic week for the British pound crosses. To be honest, I haven't looked at any of the other major pairs. I was looking at oil a little bit and the indexes purely from a interest perspective, but I thought it was a very good week in the markets. Several traders emailed me, commented that they had exceptional weeks. That's fantastic. I think we're going to have continued volatility. We're going to get the same types of setups. Today we're going to go over our simple method again and just review some of the basic concepts that happen every single day in the market. But first off, let's get started again and just keep reviewing the 3 things that markets do. They break out, they pull back, they fill more orders, and they continue. We call that a trend trade. It doesn't matter what time frame you're trading, it doesn't matter what instrument you're trading. It applies across all markets. You're in trending markets, we get a breakout, a pullback, a false break reversal, goes to the other extreme where the move originally started. We call that the false break. We see that almost every single day. 80% of the times, most breakout trades will fail. And then lastly, we see breakouts, pullbacks, and they go into a trading range. Sometimes we'll see that when we have an inside day. Sometimes we'll see that over longer time frames. Sometimes we'll see that when markets move to one extreme in London and in early US, and then we'll see them consolidate into the Asian session for another 12 to 16 hours. But generally speaking, that is all that markets do. They break out, they continue to move and trend. They break out, they pull back and reverse to the other side, or they break out and they go into a consolidation and a range-bound market. We're going to go a bit more in depth with that this week. We're going to talk about this specifically regarding round number levels. Very important. You'll see a lot of trade opportunities that are just a little bit sort of more beyond this. They're all part of that same basic model, but again, this will give you a bit more intuition about how to recognize some fantastic trade opportunities, which we're going to go over one of them today on the pound Canadian. So first of all, we talk about structure, big picture. We want to be looking, is there a bigger geometrical pattern? Is there a rectangle? Is there a peak formation? Has there been a head and shoulders, a double top, a lower double top, a reverse head and shoulders? There was a great descending triangle on the pound yen this week that went 100 pips straight down, no stress on anybody that participated in that trade. We have another example of an ascending triangle, which was part of that pound Canadian trade, which if you stick around for the last part, we're going to go through the 4 best trading setups from the week. So it's important that we identify bigger structure. Sometimes that will involve possibly some trend lines. You know, we may find that there was a running wedge on the pound USD on the 4-hour chart. So there's bigger geometrical patterns that can tune us into some opportunities when they present. Next of all, we want to be paying particular attention to the high and the low of the day. Now we've talked about the high and the low of the previous day, because this is very important for traders, because when the new day starts, we're still trading within the previous day's range. And often you'll see, when you start to really pay attention, in a lot of cases, that ADR, that average daily range, you know, for a lot of the pound crosses, it's 150, 200 pips minimum. So you've got 450 pip boxes, maybe 4 or 5, depends what it is, but they'll often act, you can see the 50% levels, all those things. So the previous day's trading range is very important, especially when we start talking about templates. People have asked, you know, how do you know what level we're in? Well, often we'll see a false move Monday, Tuesday, and we'll see a high taken out on Tuesday, Wednesday. Whenever you get a high that takes out a previous the last high before the low, now you can start counting. And often you'll see lots of moves, and then you'll see that second peak. And then Thursday, Wednesday, Thursday, we might see some sort of formation, if it is indeed going to reverse, where we get a 1, 2, 3 into a peak formation for that move back down to the low of the week. The same thing can occur on the other way. We'll often see a range-bound Friday, Monday, Tuesday. They'll take out the peak, they'll come back, so we'll have level 1. They might even come back as far as there. Level 2, and then we may even get 3 pushes down for a level 3 trade and a reversal back in the other direction. Now that doesn't necessarily happen every single week. We can get a trend trade. We can get 2 weeks running. Donchian was one of the early technical analysts that started to use some system trading. He often reckoned that there was a 2-week cycle to most of the movements. So in many cases, especially with currencies, we will see usually after 2-3 weeks max a very big reversal. But in our Monday to Friday cycle, there's usually a 3-day cycle in one direction or the other, either dragging traders up high for a move down, and that can happen on a Friday, Monday, Tuesday, Friday, Monday, Monday, Tuesday, Wednesday, all those scenarios. Or it can happen, Monday, Tuesday, Wednesday down, Thursday, Friday back up. So the high and low of the previous day and the high and low of the day are critical, especially when we start to look at the market equity opening times. Europe, London, got to get a new marker. We've got Asia close, Europe, London. That 3-hour window before the US Open. This can be the US Open. All these things are important because if they've extended it out heading into the Open, if they've moved it and moved it again heading into the Open, chances are they're going to go back and get the guy who's in the money from the London session. If they've brought it back inside prior to the US Open, chances are they're going to go back down and get the guy who's long off the bottom. It starts to become a game of common sense. The big thing that I want you to walk away with today is that if you're in a box during the trading session, what I mean by the box is there's a high and there's a low. It doesn't matter where it is, there's a high and a low. You may be inside here waiting for a trade. If you're taking a trade in here, that's 50-50. 50-50. You might be right. But if you're down here, if you're already in from up here on the way down, that's one thing. But if you're down here heading into the market opens, they're going to make a move back up 90% of the time. Now, there is a couple of exceptions to that rule. But the one thing I want you to remember is that if there's traders in the money and that move is exhausting into a low of the week, a low of the day, round numbers, and you start to get pins and hammers and you get a 1, 2, 3, then another bar and you're at numbers, that market's going back to get some of its money back. We're going to go over a couple of those setups. So market opening times are critical to timing some of these moves. Again, if you're inside heading into an equities open, chances are the first move in that equity opening time is going to be a stop hunt. It can be back inside for a move down. It can be back down for the move up. Again, we talked about that 3-hour window, those 3-hour rotations. If they drag it out for 3 hours and you're heading into an equities open and the stop hunt has dragged down in that second window of 3 hours from the Europe-London Open, chances are they're going back up. If they've gone back up somewhere up to here into the just prior to the open, chances are they may go back down to get the guy who's long off the bottom. So again, just starting to think about high and low. What time is it? Are we at numbers or are we at the high and low? What kind of price action pattern are we getting? Are we getting pins on the bottom, pins on the top? Have they gone 1, 2, 3 into the open in big burst candles, taking out a high or a low? Those are ideal conditions for starting to pay very particular attention for a trade setup about to happen. Next, we talked about the numbers. The 12 candle window is that 3-hour window, the hour before the equity market opens, the hour of the market equity openings, and then the hour after. People have messaged me and said the Forex market's open 24 hours a day. We are not talking about the Forex market hours. The markets move when the volumes swell, and the volumes swell when the equity markets open. They will typically time a lot of those movements with the equity opening times. Price confirmation, we just talked about that. We want to see pin hammers, we want to see engulfments, we want to see 1, 2, 3s, stop hunts to the high or to the low, or we want to see pullbacks to a level for a continuation of the original move. And that can be long or short. Pins, hammer, engulfments, continuation, and trade management in live time. Again, this is where your performance review comes in. A lot of traders have messaged me also saying they got into the trade, they went to break even, or they got out of the trade, whereas other traders just got in, put their stop in, walked away, got 50 pips. That is an art that you have to perfect on your own time. Your approach to the market, your rehearsal, your preparation, your understanding of what's happening in the markets, only you can work through that part. There's nothing that you can learn from looking at closed trades or looking at somebody else doing it live. Only you can finesse that through your own confidence and skill development that comes either on a daily basis or on a weekly basis, because the point that's critical about some of these 50 pip trades is that you don't have to get 50 pips every day. But if you get really good at spotting the best trading setups and you have the confidence and the expertise to really master your craft at executing those trades, then you can scale them up. I'm going to tell you a real quick story. I had a chat with a broker in Melbourne on the weekend, and lovely guy. We had a chat about the retail client base that he handles, and I asked him what his largest traders, his largest retail client traders in terms of size were trading. And he said his biggest traders were trading between 500 and 1,000 standard lots. That's $5,000 to $10,000 a pip. And he said they have a very high execution rate in terms of being accurate. So just to sort of reinforce that if you get really good and you're patient and you focus on mastering the process, 50 pips a week is more than enough if you're trading large enough. So remember that. It's not about trying to scalp pips all the time. Just scalp pips and make some money and trade bigger and make some money. It's about mastering the craft and having the confidence to step into the market at the right time, at the right price level, managing your downside and having the confidence to know that there's a high degree of probability, because there's never absolute certainty, but a high degree of probability that you're about to be in a 50 or 100 pip move, and that you've managed your downside. You're going to cut your losses, but you're going to hold on to that no matter how they try to shake you out along the way. And we went over that in the last video about how they'll do things even in mid-trade. We're going to review that a bit in the next screenshot examples about how to go to break even, and just, again, having the confidence to hold on for that 50 pips. And that's where the review and improve and scale process comes in. You just got to keep going and hitting the trades. You're going to make mistakes. You're going to have losers. You're going to miss out on profits. You're going to get stopped out for more than what you planned on. You're going to make mistakes. You're going to maybe take too much size on the wrong trade setup, and you're going to get in too early. All these little things. But don't blow yourself up. Understand that if you're patient, and it's more about developing the skill set, because in 6 months' time you can make a massive amount of capital back if you're mastering that craft. It's one thing getting a few lucky trades, but if you're going in and week out and you're up and down, and you're sort of wavering through the process, it's more than critical to be improving at least 1% a week. If you do that, your results are going to show it. Your confidence is going to go through the roof. And we're also going to go a bit further in this next week, just about mastering some of the daily routines to boost your focus, to boost your mental preparation and understanding about what you're actually trying to accomplish when you're at the screen, observing yourself, self-talk, and just being completely focused on the process. So hopefully you get value out of that today, traders. We're going to go through some examples now. And again, big picture structure, high of the day, low of the day, market equity opens, round numbers, that 3-hour window, 12 candles, price patterns that confirm our entry, pins, hammers, engulfments, putting the trade in place, managing your risk, having a profit target plugged in, or at least knowing where you're looking for the profit target at, taking money off the table, managing that trade throughout its fruition no matter what they do to you in live time, review your results, improve upon what you're doing, focus more on what you're doing well, minimize what you're not doing well, and scale it up in size. So stay disciplined, stay focused. Have a great weekend. Let's look at some examples now.
Good day, traders. Stacey, Burke, continuing our discussion on the best trading setups for the week. Monday, the pound Canadian gave us an absolutely beautiful open drive trade. The market originally broke out in Asia. We had a stop hunt, straight up, explosive move up for slowly auctioning down. The market came back below the double zeros inside of the previous day's range. Went back up to double zeros, weekly retested the move to the low, was unable to get there. 1-2 down again before popping up above the double zeros as we headed into that last hour of the Asian market, sideways above the double zeros, and then a pin hammer at the first candle of the hour at the Europe Open. Now, also, if we look at structure, just on a smaller geometrical level, we had an ascending triangle. That market exploded straight up for 50 pips. Some traders actually got more out of this. I had a couple of traders message me that they were targeting further, but when the 1, 2, 3 happened, they followed it up to the little candle before taking their profits. So again, we had structure, we had the high and low of the day. So the market obviously the trade did not occur at the high of the day or at the low of the day, but we were above 50% at round numbers, targeting the high of the day. That market took off very aggressively, which is what an open drive trade entry should do. So again, in terms of even if you look at this from a market profile perspective, if our point of control was at the double zeros, the 7,400 level, this trade gave a fantastic risk reward, 1 bar stop, 50 pips, over and done before most traders even started to get into the market. So fantastic. I thought that was one of the best trading setups on Monday. There were other trades, but as far as I'm concerned, in terms of fitting our 12 candle window, this was the best of the bunch. On Wednesday, we had a fantastic trade. I had several traders that took this one low of the day into our 12 candle window at the US session. That market went 1, 2, 3 pins on the bottom, but traders who may have entered in somewhere down in that second candle, that was the last candle of the hour, below numbers after a 50 pip move. And also what's important, you need to pay attention that there's a big gap here between where the trader entered this market short at double zeros and where it went down to, meaning that they will go back to get the money. This is a really important thing to be noticing on the charts when there's a gap like that, and they extend that move out. So they extended the move that extra 3 hours after moving it down 100 pips, consolidating it, and then popping through into the next breakout pullback, continuation down, another 50 pips into the beginning of the US session. That's almost a dead giveaway for a 50 pip stop hunt minimum back to the traders who are short at double zeros. This trade actually went 100. I was in this trade for 50 pips, and a couple traders did take the full 100 pips off, right up to the 50 up above. So congratulations, traders. This was a fantastic trade setup on Wednesday, and you're going to see more of these. Just to highlight this at the high as well, if you look at the bigger structural pattern that occurred into the close of Tuesday night's session, traders, this is a great example of a descending triangle just falling through the double zeros straight down. That's a runaway trade setup. Some traders actually may have shorted this right in Asia right as soon as it started to drop down and consolidate underneath that peak formation low. So good job. Thursday we had a fantastic setup. Again, an example of a market breaking into the double zeros, pulling back, retesting it, selling off in the London session for almost 50 pips down to the redrawn low of the day, but then a creeping trend back up into the US session. So we talked about those 3-hour cycles. Part of this 3-hour cycle started to come back up in towards the redrawn high of the day. When you see 1 push, 2 push, 3 pushes up into that US Open, 3 pins to the high. Not a normal engulfment, but if you look at this, we have a 1, 2, 3, and the engulfment bear candle closes below the second candle inside the peak of the 3 pins. Then you fight for the best price, which is at double zeros, for a 50 pip plus move down to the low of the previous session. This was a fantastic trade setup. Not a lot of traders took this, but the ones who were tuned into the pins on the way up started to pay attention as the US session opened. When you had the 1, 2, 3 engulfment back for the short, the pin hammer off numbers, 50 pips plus. Good job, traders. And then on Friday, again, several traders told me they took this trade. I also took this trade. The market broke down, as we sort of saw in the daily levels video, pulled back to the numbers to double zeros before moving quickly down through the 50 pip box, pulling back again, and not quite a 1, 2, 3, but very close. 1, 2, 3, 1, 2, 3. The pin hammer. Then if you look at this, is also a 3-bar reversal similar to the one we just looked at. Bear candle, pin hammer for the long, which is the first candle of the hour of the New York set, just prior to the New York Open. But the candle that breaks out, the bull candle here, also engulfed the smaller bear candle. That's a 3-bar reversal with an engulfment and a pin hammer. That's a very, very powerful reversal pattern. Something I didn't mention in the other videos is that when this market clears a previous high or low, that's when you definitely want to be moving your stop to break even. That is a point where the market can reverse quite quickly to come back and either stop you out at break even or even move through your position for a measured move. So again, we had structure, we have a bigger picture, we have the high and the low. This was the low of the week actually. And then we had round numbers, we had the equity opening times. Sorry, this was slightly outside of our 12 candle window, but the prominence of this being at the low of the week, just extending out towards the previous day's low and then reversing for almost 100 pips back up. So fantastic trade, great way to end the Friday. Review these trade setups, start screen capturing your own and making your notes. You know, these are going to show up again next week, traders. So these are examples of lock and load 50 plus pip trades per week. Have a great trading week. Study hard this weekend. Keep getting better. Next week's going to be a big week as well. Have a great weekend, and may the markets go with you.
Hi traders, it's Stacey Burke from Stacey Burke Trading. If you haven't done so, please head over to my website at staceyburketrading.com. I create updates on almost a daily basis, and I would love for you to receive them. Just click on the blog. If you want to enter your name and your email address, I'll send you my free audio program, the 7-Step Daily Routine for High-Performance Traders. This is essential knowledge for all traders in all markets, and this is for helping traders to master the market with discipline, confidence, and a winning mindset. I appreciate all your feedback and comments. As always, traders, stay disciplined, and may the markets go with you.